Okay, quick video on Taylor trading and a little bit of other things splashed in. Let's take a look at the last couple days. October 26, 2007 was Friday. And first concept from Taylor is simple, very, very simple. Um, the very important thing that Linda Raschke stresses and what Taylor professed to try to do is to watch what happens around highs and lows. It's very telling information. And this I'm going to weave that back into market profile a little bit. In market profile, you have a concept that says, okay, the market's found a fair point of value. It's been trading, in a tight range. It tries to move away from that range. There's two responses, right? Let's say it moves up out of that range. Sellers can come in, responsive sellers we call them in market profile. Responsive sellers see the higher price and they push it back to the previous range, and it stays in that zone. Or the higher prices, something happens where the higher prices start to spark more buying. So higher prices are actually attracting buying, and that creates a trend. And that's the less the first one's more has a higher chance of happening than the trending action, right? You'd expect one thing, but sometimes the other thing happens, and not all that seldom. So you have to be on the lookout for when that happens. So that's kind of similar to this, where if you take out the previous day's high, the expected response is for it to push back into the previous day's range. But sometimes it won't. It'll continue in that direction, right? So that's what makes highs and lows so important to watch how it does it. So let's go back on to October 17th. You can see we took out the previous day high. It gets marked with a bar. All I'm doing is marking if there's a in the morning session only. So up until noon Eastern, what is the previous day's high being taken out? And the previous day here on this day, the previous day high was taken out. Okay, on this day we have an inside day where the high is below the previous day high, the low is above the previous day low, so no mark. Here you have a the non-expected response, the rarer case where the low is taken out and it attracts sellers. Okay, lower prices are attracting more and more sellers. Here you have a push below the previous day's low, makes a new low, and the expected happens. It starts to get pushed back up. Okay, so now let's go to concept 2. Another very simple one, but very, very powerful and important. This is just going to do print whether a high or low. All you do is you look at the high bar of the day and the low bar of the day, and you see which one came first. So on this day, here's the high bar, was near the open actually. Here, the highest bar of the day, it never got exceeded. The lowest bar is here. The low bar came after the high bar, so therefore it's a high to low day, and it marks the red bar. Okay, on this day here, you have, the low bar was made early, the high bar was made second, and it trades low to high. Okay, so you have two concepts here, and let's combine them. When you have when you might expect a low to high day, here you have 3 downs and an up, right? This is actually a pattern. 3 downs and an up often means the next one's going to be down. You don't know that, but here you have a low violation and more sellers come. Let's look for one. Now let's add one more concept before I go to the next step. Okay, let's add some price pivots. Okay, on this day, on this big down day, 1530 became a very popular price. Okay, and it was just a price that day, and later on you're going to see how 1530 becomes more and more important. We tested down, and this low for the day again here, the low of the day becomes a very important price, 1505. 1505 becomes the most popular price. If you pulled up the volume distribution for this day for 1022, you'd see that 1505 became a very popular price that day, the most popular price of the day. That was also the low of the day here. So you can tell how these lows and highs are important. We traded up. We tested this 1530 area. We stopped short of it. We made a lower high to that. Again, we're tracking highs and lows. We gapped down away from that, and we trended away. From this zone. What happens? We go down. We test this 1505 area. It comes down. Looks like it could either fall apart or it's going to find. These buyers are going to come back. The buyers came back again in this case. They bought that day at 1503, I believe, was the most popular number that day. So we've had a lot of buyers at 1505, a lot of buyers at 1503. It then makes a key higher low and launches back up. It goes up and it tests this 1530 again. And here's where everything lined up. You've had 3 low to highs in a row. You've had low, low to high, low to high, low to high, 3 in a row. A fourth could happen, but if you have a high violation, 3 low to highs in a row, and it runs into resistance at 1530, everything's come together here for a great short. Okay, so you short here, and you're playing off this resistance, hoping it's not going to go through there, and when it rejects this high to low day could kick in, right? And that's what happened. Traded all the way back down to here. So you've had now you're still analyzing the situation, which is what happened. We had a lot of buyers 05. We had a lot of buyers 03. What happens here? It forms a higher low to this low, and it rejects it, and it comes back up. So you now have the same pattern: 3 ups in a row, 3 ups and a down, often gets an up. This is supported by this higher low. But the problem is you're pinned up against this 1530 zone. You've challenged it once, you've challenged it twice. Here we gap through it on some Microsoft news. We come up, so it's another high violation, which is a potential short. So not a good spot to get long. But it trades back down, and it ends up making its low first. Here's the low bar of the day, and trades up. It actually washed out everyone below that 1530. Everyone who was using 1530 as a stop got washed out right there, and then it ran up. Anyway, I'll bring in some VWAP into another video.